So, two CFOs, same initials, same first name. Used to sit right next to each other, actually, on the Lehman fixed income floor all those decades ago, sadly. We do sound different, though, so that's the way to tell us apart, and some facial hair. I'll take us home. We then will go to a Q&A session, which Mark will join us for. So you've heard from the entire senior management team, and we've really tried to focus the presentation today on feedback and focus points that we've heard from all of you in the last year, plus or minus. You've heard about the business model, asset and liability construction. You've heard about risk management and product development. And then Marty sort of finished it off with just what I think is the raw earnings power of the franchise that is Athene. So let me connect all of that to the merger and how the merger of the two companies creates incremental value for shareholders. So when we look at the merged company, we see four really important strategic benefits, and none of these existed before the merger was consummated. Firstly, alignment between Apollo and Athene, and alignment between the merged company and our client set. Secondly, the ability to create differentiated asset flow, which just produce more yield. And that's attractive to a bunch of constituents, which we'll talk about. Much better coordination across the company to allow product development and innovation, which Grant started to touch on, and a lot of good things ahead of us in that respect. And lastly, capital efficiency and capital flexibility. Massive amounts of capital created and built into the system to pursue growth. And I'll touch on each of these right now. So Jim earlier teed up the benefits of alignment. He used this slide, but for the right-hand side of it. And the point here is origination is valuable because it has multiple homes. And those multiple homes can create multiple forms of earnings. And because we own the position on our balance sheet, and that position is valuable and attractive from a risk-reward perspective, our clients also want to own that position. And so assets are originated and end up on the balance sheet of Athene, creating spread-related earnings, and or they can end up on the balance sheets of managed accounts, creating management fees and FRE, and or they can be syndicated through our capital solutions business and create syndication fees, another form of FRE. So before the merger, we cooperated. Cooperation created growth, and as we see it here today, we can identify about $130 billion of assets that are in our system today, of assets under management that were created by seed capital from Athene. And this includes our hybrid value business, it includes our infrastructure equity business, it includes MidCap, the middle market lending platform, Athora, the retirement services business in Europe, and others. And that was a good result. We're happy with that, but we do really think that much better results lie ahead. And it's really driven by at least four different areas of cooperation and coordination here. Firstly, continued expansion of new platforms. This is a key part of our bet to get origination from $80 to $150 billion per year over the 5-year period. Acceleration of new product development. Grant touched on some of this earlier in the form of annuity products. But as we build out the platform broadly, life sciences, GPLP solutions, climate financing, and more, that growth can be seeded by Athene. New businesses, we created an enhanced capital solutions business with the benefit of capital from Athene and a strategic third-party LP. And we're penetrating Asia in a way that we haven't been able to do before. Challenger, FWD, and then building out teams and capabilities across Asia broadly. So I think a recent example is really instructive here. We recently financed a $5 billion fund-level loan to Vision Fund 2. SoftBank approached us. The loan started at $4 billion, it grew to $5 billion. And this loan has really attractive characteristics. It's backed by 150 portfolio companies in that portfolio. It has a very low LTV and a high attachment point. It creates about 300 basis points of outsized yield relative to comparable credit in the public markets. It's A-rated. And that asset ended up in 3 different places. About a third of it went onto Athene's balance sheet in what we call the fixed income replacement bucket, earning that 300 basis points of excess return. And the other 2/3 was both syndicated to third-party LPs, including insurance companies, and allocated to managed accounts for which we earn management fees. So that transaction, there's very few firms that could take down a transaction of that size to start with. It had the financial benefit of creating SRE and then 2 different forms of FRE in management fees and syndication fees. So third-party investors look at that business and they want to participate in it. And so, and that comes to us in 2 different forms, what we call managed accounts and syndication through our capital solutions business. So I think a good example of that is this business that we call high-grade alpha. This business attaches to that type of business. It has it's capital that wants a risk-return profile similar to the transaction I just went through. We've taken this business from 0 to $7 billion of managed account assets under management in the last 12 months. And at the same time, we've developed relationships with insurance companies who want to co-participate in that same risk. And so investors will decide if they want to take a piece of a transaction through syndication or whether they want to allocate money in the form of managed accounts to us. But they're just 2 other examples of FRE that we create as a direct benefit of that. That's an opportunity we didn't have before. So the second strategic benefit, a lot's been said about the importance of Athene's equity portfolio, which we also call the alternatives portfolio. It's the 6% of assets that are invested in equities, and that has, over time, created 3 benefits for us. 1, origination platform development. 2, seeding new funds. And 3, building out our retirement services ecosystem, including Athora, Venerable, and the like. As it relates to origination platforms, this is really important to us. It's our ability to create differentiated credit of high quality, less liquid assets that just yield more. And again, a key part of our bet to get assets originated each year from $80 to $150 billion. And we expect this to continue to grow, as I'll describe a bit more. We think owning the means of production and just being able to create assets is a really important part of the Apollo ecosystem. These platforms today, many of which we've spoken about at the Investor Day on earnings calls, are now run rating their annual production at about 2 times the level they were 12 to 18 months ago, and we expect that to continue. These are high-quality businesses, high-quality management teams, and we expect each of them to expand and scale over time. So what does proprietary origination provide for us financially? Multiple earnings benefits. There's 2 forms of spread-related earnings and 2 forms of fee-related earnings that come from it. And so on the spread-related earnings side, investments in the platforms have an attractive risk-adjusted equity return of low to mid-teens returns. That comes through in SRE, which Marty described. The production from those platforms creates rated high-grade paper, which comes into the fixed income category, earning excess return in the investment grade part of Athene's balance sheet. And then on Apollo's balance sheet, we earn management fees for the same assets, including if they're allocated to third-party accounts, or in many cases, we earn syndication fees on assets that pass through and are syndicated to other syndicate partners. So the third strategic benefit, I think we are very early stage, and Grant made the same comment earlier, that there's an awful lot ahead of us here. Let me give you 2 examples of things that we're working on that are sort of early stage innovation that are directly benefiting from the merged company. One is related to the alternatives portfolio, the equity portfolio on Athene's balance sheet. That has, as Marty went through, created low double-digit returns over a long period of time. High Sharpe ratio, low standard deviation of returns, very attractive risk-return portfolio for many investors. So we see institutional demand for that product. We also see retail demand for that product. And so we plan to offer this as a product which is attractive in bringing third-party capital in, but also has the financial leverage impact of creating more capital to seed new businesses, new platforms, and develop new products. Secondly, completely separately, for most of our existence, Athene has largely catered to tax-sensitive investors in the form of tax-wrapped product or annuity-wrapped product, and Apollo has largely catered to tax-insensitive investors in the form of pension plans, sovereign wealth funds, and the like. And again, this comment was sort of alluded to earlier. We are planning to create Apollo product and distribute that in a tax wrapper, an annuity-type product, which we think provides retail access to institutional quality product. I would expect the first of these to roll out in the second half, and the second of these to be sort of later in the year into early next year. And the fourth, last, certainly not least, I think, is benefit of the merger is capital. Capital efficiency and capital flexibility. I do think the benefits of this today are clearer than they were 9 months ago when we did our Investor Day and before that when we announced the merger. I think the platform has multiple sources of capital that are available within the structure, and there's multiple sort of forms of flexibility around how that's deployed. After the restructuring of the asset manager balance sheet that we did in the first quarter, I think that we have the lightest balance sheet, the lightest asset manager balance sheet in the industry. And then Athene itself has multiple forms of capital that Marty went through. Excess capital, debt capacity, ADIP, and also the benefit of the alternatives portfolio. And then if you recall, sitting above both the retirement services business and the asset manager is the holding company that we've indicated will create $15 billion of investment capacity over 5 years. So how is it so efficient? I think the reality is we have a lot of capital in the system that can create earnings growth that's not dilutive to holding company capital. Athene today, these are the same numbers Marty just went through. Athene has $3 billion of excess capital. That will grow just as Athene's business creates earnings. ADIP has about $1 billion of capital today. We plan to raise a successor to that later this year. Athene has about $3 billion of debt capacity. That will grow at constant leverage just as the business grows. The alternatives portfolio today is pretty much fully invested, but we plan to grow that with institutional and retail demand over time. We have strategic partnerships. Mubadala was an important partner to us in setting up our capital solutions business with Athene. There are others that you should expect to hear about. And then we have the holding company, which over time will have $15 billion. And I think really importantly, we have choices around how we spend this and allocate capital around the system. Each of those uses of capital create earnings, and I won't sort of go through the chart here, but it's in almost all cases there's FRE and SRE that's created as a result of using the capital. So the coordination, the operational coordination, the financial coordination has multiple financial benefits around the structure. So connecting back to Marty's points on capital creation, using a $2 billion after-tax number, this is the $4 a share that Marty indicated in his slides. We have a choice in how we allocate that $2 billion of capital. We've indicated $750 million a year of capital being upstreamed to the holding company, and that becomes part of the $15 billion. And that leaves $1.25 billion for growth. And when you staple that $1.25 billion to ADIP's capital, to increasing debt capacity, you can fund growth organically, inorganically, and the sort of virtuous circle of that is it then creates further alternatives capacity to invest in all the other benefits that brings. So if all we do is organic growth and no inorganic growth with expected runoff of the business, we create $1.5 billion of alternatives capacity every year from the organic growth that we're currently seeing. So, and that then translates itself into the same FRE and SRE benefits that I talked through that you can see on the right here. So busy slide, similar sort of to one that Marty used. I'm not going to go through every number. You can sort of take a look through it. I think what this does is reinforce the capital flexibility and the generative scale that is Athene today. And if you look at 2020 and 2021, I think it's pretty instructive. In 2020, $56 billion of asset growth was funded. It was pretty much 50-50 split organically and inorganically. It was entirely self-funding. There was no capital that needed to be raised. And that also included a year when there was $400 million of stock that was bought back, that was sort of taken off as part of that. So massive growth of a scale of $50 billion and plus. 2021 was a slightly different story. No inorganic growth, but a record organic year with $37 billion of production. In that year, there was $1.3 billion of excess capital created, and that was after the first $750 million dividend was paid upstairs. So, $2 billion of capital created in a record year of organic growth, and then a lot more growth can be accommodated with the capital sources that are created. And then finally, the role of the holding company. This is just a redo from Investor Day, but it's really important. This is the strategic use of capital. I haven't spoken about this at all as I've gone through my comments, but all of the other growth is funded by capital that's built into the system. We then have investing capacity of $15 billion up top. And we've indicated that 5 of that is to pay the fixed dividend, so there's $10 billion left, and that will be to fund growth, to fund strategic growth, FRE accretive add-ons, increases in the dividend, buybacks, and the like. So I think it's actually really instructive to look back at the last 15 months and what have we done with the capital sources. We've done a lot. We've bought a lot of origination platforms. We've invested in strategic assets. We've bought an FRE business in Griffin, which is also very strategic to us. And we've made investments in Asia to grow out the retirement services business there through FWD and Challenger. And you can see the sources of the capital, and you can see the earnings profile that's created as a result of that. But it shows a nice diversification, and it, I think, reinforces the flexibility we have within the system around how we invest our capital. So let me just cover off a few other points quickly. And I guess the question we all ask ourselves is, why is $1 of SRE worth 1/3 what $1 of FRE is worth? And I think Marty did a really nice job at sort of looking at the correlation between the two earning streams and the recurring nature, the sticky nature, the high quality nature of the assets, the growth in that earning stream. And it's being created with a really efficient capital source. So it seems to us that it has all of the characteristics of a valuable, highly attractive earning stream. And to underscore that, I would pick up the comparison to the non-traded BDC income stream. Both are attractive. Both are valuable earning streams. There's a really important distinction, though, in that the retirement services earnings is driven by high-quality assets, investment grade. We earn in SRE 100% of the ups above the cost of funds on the annuity book. So everything above 2.5% is SRE. The assets are held at cost, so there's no cyclicality in that earning stream to mark-to-market movements. And we provide 8% capital to create that growth and stability. So we think this is a very attractive earning stream. Paired with the previous point, growth, stability, durability, stickiness, et cetera, which deserves an appropriate valuation. Finally, the merger didn't really change anything around the amount or quality of management fees. The fee structure between the asset manager and the retirement services business is the same as it was pre-merger. It's market-based, which we've looked at many times over the years. It's paid in cash every quarter. And with that fee in place, Athene has achieved 17% ROE over its life and a yield outperformance on the assets. The scope of services is broad. We do a lot for that fee, and you can see that in the middle column here. And I think it's important that the fees are mark to market in two pretty objective ways. One is the investors that come into ADIP pay the same fee structure and a fronting fee to Athene. And so that's been a very successful structure for those investors. And as I said, we expect to roll into an extension of that structure later this year. And then investors who want high-grade alpha pay the same fee rate or higher as they come into that business, and that's the $7 billion of capital that we've accumulated in the last year. So I'll wrap up and we'll move to Q&A. We're focused on 4 issues. We've really tried to tailor this on what we've heard from you as the focus points. One is sensitivity to the credit cycle, which Doug hit and Jim hit, and looking at how we stress the book, the construction of the asset classes that we think are perceived to be more risky, structured credit and commercial real estate, and looking at how those markets have evolved and how we play in those markets in terms of our seniority. Interest rate exposure, I think Grant made the point very forcefully, we win in a higher rate environment, and we're starting to see that come through in earnings. Liability flight risk, I'd encourage you to go back and re-look at Mike Downing's section, maybe 3 times. There's a lot of really good information in there that I think stratifies the book into the true parts of the book that actually have surrender risk and what the consequences of that are. And in the sort of the California Falls and the Pacific Ocean scenario, there's a $500 million economic loss over a period of years. So what we think is a very contained risk profile to lapse risk. And then balance sheet heavy. We look at our business and say there's multiple forms of capital. There's a lot of flexibility in how we use it. We've showed how we've started to employ that strategy in the last year, and you'll expect to see more of that in the years ahead.